market timing is a very sexy concept. I'm going to be in the market when it's going up, and I'm going to take my money out when it's going down, and then I'll put it back in when it's going up. And it sounds like a fantastic thing to do. The problem is, my experience has shown me that it's almost impossible to do successfully over extended periods of time. I've seen people who have gotten it right, gotten out of the market before the market went down. I've seen people who got into a market before it went up. I have seen very few people, actually none, who can do that successfully year after year, time after time. You look at the declines we had in the market in 2008 and the beginning of 2009, with hindsight we can go, oh yeah, this market is going down, it's going to go down a lot. But the problem is we're not living in the future. We're living in the current, and we only know what's going on right now. So you don't know whether this is a situation where the market's going to go down 10% and then bounce back up 30%, or whether it's a situation where it's going to go down 10% and then down another 10 and down another 10. When you get out of the market, because you're timing, you're not making one decision, when should I get out of the market? You're making two decisions, and that is, when do I get out of the market, and then when am I going to get back in? And we saw a lot of people who got out of the market near the bottoms in March of 2009, and then when the market rebounded throughout the rest of the year, they missed the upside because they could never find the right time to get back into the market. Then they'll go, okay, when it's the right time, I'll get back in. But the problem is, if the market goes up, and you go, oh man, I really don't want to put my money back in the market now because it's a lot higher than where I sold it. Or if things go down a little bit more, you go, well, I don't want to put my money in now because it's going to keep going down. And they end up never getting reinvested. Now, I'm not saying that you should just take a market beating more than you feel comfortable with. I think that the answer is, instead of trying to time the market, which is impossible to do, a better solution is to have your asset allocation, that is how your money is split between different types of investments, set in advance to a volatility level that you're going to feel comfortable with. That is a much more successful strategy than trying to time the market.